We're looking at an analysis report that lays out a comprehensive bull case for Plug Power, PLUG, and it's aiming to back up a potential 300% upside.
Yeah, this is a really compelling piece. You can see the quality of the data collection is very high. And the whole narrative, that urgency, the high-risk, high-reward framework, it's really well established.
It is. It hooks you right in. But to get it from being just a strong story to a truly robust investment thesis, I think we need to zoom in on the structure.
And the mathematical accountability. That's the first thing we should probably tackle.
Absolutely. The first thing that jumped out was this kind of gap between the huge headline price target and the fundamental news that's supposed to support it. How do we start closing that?
Well, the analysis needs to more directly connect the catalysts to the valuation target.
Okay.
Right now, the report has what it calls the money shot, right? The math showing that 196% gain to $7, which is the Wainwright target. It's a great hook.
It is a great hook.
But then the fundamental catalysts that follow, the NASA contract, the 45V tax credits, they're presented more as general good news.
Right, like validation for the company.
Exactly. They feel like validation, but not like explicit financial drivers that actually get you from the current price, under $3, all the way up to that $7 target.
It makes them feel a bit like a checklist of positive press releases rather than
inputs into a financial model. Precisely. And that structural separation, it kind of diminishes the analytical rigor. It's treating them as narrative points, not math.
So the suggestion here is to really integrate a clear, forward-looking metric. Something that shows how these deals are actually modeled into that price target.
You have to convert that narrative validation into verifiable financial progress. We need to turn validation into valuation. It's critical, especially for a company with this much leverage.
Okay, so let's get specific. What's a concrete example? Take the NASA contract.
The NASA contract. Okay. The report frames it as validation of the technology. And that's fine. It is.
It is, but it's not enough.
It's not enough. To really strengthen the analysis, you need to quantify it. Frame that contract as a specific, measurable anchor for, say, projected Q4 revenue, or maybe future recurring revenue that underpins the analyst's model.
So you're moving it from just a PR win directly onto the balance sheet. I like that. What about the biggest one, the 45V credits? That feels like the elephant in the room for the whole industry.
It absolutely is. I mean, the 45V production tax credit is the single biggest policy driver out there for green hydrogen, but it's also been, notoriously complex with some clarity issues.
So the analysis has to show it understands that nuance.
Yes, the granular impact of that lever. So one way to do it is to quantify the required impact of getting more clarity on those credits. You could suggest a specific required jump in gross margin percentage.
Giving it a measurable outcome.
Exactly. State something concrete, for example. To justify the $7 price target, the 45V credits have to immediately translate to, say, a 3 to 5% improvement in the cost of revenue.
I see. So that connects the macro policy event directly to a specific margin expansion.
It does. It tells a sophisticated analysis report, look, we know what the financial hurdle is, and we've identified this policy as the precise tool to clear it. That is a much, much stronger argument than just listing the credits as a positive.
That level of detail really shows the heavy lifting's been done. It demonstrates an understanding of the mechanics needed to actually hit that target. Okay, so closing that valuation gap is non-negotiable.
Absolutely essential.
And, speaking of non-negotiable things, that high-risk angle is the next area where I think we can elevate the analysis.
Agreed.
To really boost the credibility of this contrarian buy idea, the report needs to get explicit about the operational hurdles, not just say something like bankruptcy fear is fading.
Yeah, that's laid out very clearly. The analysis is correct, right? It identifies the stock burns too much cash, and that it's fundamentally a high-risk, high-reward situation.
And it does mention securing financing, the cash runway.
It does, but then it immediately pivots to the more exciting part, the squeeze factor, without really giving any context on the operational execution that's required to get out of that danger zone for good.
And that's a credibility risk, right? That lack of detail on the operational challenges, on the required cash burn, it can create a gap for a really deep expertise reader. It makes the whole contrarian buy feel a little more speculative than calculated.
So what's needed is a dedicated section, one that translates that risk into measurable execution requirements. The report makes a great case for survival, but now it needs to define what success actually looks like inside that survival window.
Right, so we position the financing not just as breathing room, but as a precise window of opportunity.
That's the frame. And a really effective way to do that is to benchmark the new financing against the company's known quarterly cash burn rate. You use that to establish a specific time to positive cash flow requirement.
Let's make that concrete. The analysis mentions, I think, 5 quarters of runway.
Okay, so use that. Give it a hard deadline. Quantify it precisely. Something like, the secured financing provides approximately 5 quarters of runway, which means positive operating cash flow must be achieved by, say, Q3 of 2026.
That's powerful. It transforms the balance sheet risk from this kind of vague worry into a key performance indicator that any investor can track, quarter by quarter.
It gives the risk profile teeth.
It does. But is focusing only on cash flow enough? I mean, for this company, operational success is so heavily tied to scaling production.
That's a great point. It's not. We also need to define the operational turnaround point. If the money buys them time, what must they do with that time? They have to achieve a scale that actually stabilizes their margins.
So what would that look like?
Well, an alternative suggestion, or maybe one that works alongside the cash flow metric, is to define a specific target for liquid hydrogen production capacity.
Like a specific number of tons per day?
Exactly. Something like hitting a required threshold of 50 tons per day, or TPD. And you dedicate a section to explaining why that number is the critical benchmark.
And why is it?
Because it's widely seen as the point where economies of scale finally start to kick in and offset the incredibly high capital costs of production and transport. Hitting 50 TPD is the definitive sign of operational scaling. It's what's needed to sustainably fix the balance sheet and cut that burn rate long term.
So you're giving the analysis report a measurable operational goal, right alongside the financial goal of positive cash flow.
You're defining both, the financial timeline and the physical production hurdle. It transforms the financing from just a footnote about survival into a structured operational plan.
That definitely elevates the quality of the risk assessment.
It moves the discussion from just survival to a measurable trajectory.
Okay, now let's talk about structure, because I think the sequence of the arguments is so important here, especially with the urgency they're trying to create.
I agree completely.
The structure and flow of the report really should be adjusted to tightly integrate the technical analysis, the support and resistance levels, with the timing of that squeeze factor. That's how you maximize the urgency of the whole breakout narrative.
Yes. Right now, the analysis report kind of separates the different pieces. You've got the fundamental catalysts, all the good news fuel, in one section.
Then you've got the squeeze factor, the high short interest. What is it, over 20% of the float?
And then later on, you get the technical analysis, support down at $2, resistance at $2.40.
And while all the components are there, you're right, that separation just dilutes the impact of the explosion idea. The whole thesis relies on combining those factors into one single kinetic event.
The technical setup just comes in too late in the framework. It kind of dulls that sense of immediate opportunity.
So the suggestion is to create a kind of narrative fuse, one that directly connects the news to the trading psychology?
Exactly. You resequence the analysis. You put the discussion of the most immediate catalysts and the key technical resistance levels right next to the short interest data. That creates a really compelling cause and effect narrative that drives home the urgency.
I agree that the kinetic thesis is the most powerful part of this, but does linking the catalyst so tightly to a technical breakout, does that risk making the fundamental case seem secondary? Like it's just about a short-term trade?
That's a fair question, but I think in this specific case, the entire analysis is built around that immediate, high-risk, high-reward contrarian buy.
So the structure should reflect that.
The structure has to reflect the immediacy of the trade setup. The goal is to show the analysis report the exact moment the fuse ignites the fuel. So you can move the discussion of the immediate technical resistance at $2.40 and the psychological one at $3 to come right after the most imminent catalyst. Let's say it's the clarity on the 45V credits.
Okay, so the news event becomes the trigger.
It's the trigger, precisely. You frame the argument explicitly. This upcoming news event is the specific force required to push the price past the 240 technical resistance. Then you lay out the full chain reaction to really maximize that feeling of urgency.
Wait, so just to clarify, the technical resistance at $240 is the trigger, not the final destination. And the destination is really that psychological barrier at $3, driven almost purely by the short interest covering.
Yes, that integration is the key. That clarifies the kinetic chain for the reader.
Okay, that makes sense.
So a concrete example of this restructuring would be to frame the whole breakout argument as one integrated thesis. Something like, The expected clarity on the 45V credits is the necessary news flow to push the price past the $2.40 technical resistance. Crossing that point will immediately engage the 20% plus short interest, forcing them to cover and triggering the gap fill up to the $3 psychological level.
And potentially up to 450 on low volume. I see. That seamlessly integrates everything, the catalyst, the technical level, and the squeeze data, into a single, actionable event.
Exactly.
This analysis report, it has really strong raw ingredients for this 300% upside bull case.